So opportunity is because of your system. Okay, your business system is like that. It gave the opportunity to even those who are ethical persons, even then they have the opportunity to commit fraud. For example, you allow your employees to go and make entries on backdated entries. All right, this is the loophole of the system. So if I'm sure that you have experienced in Carrefour or in OneCard or whatsoever in Metro, right? If they make a wrong entry, they cannot redo that one. They need to ask, or they need to ask permission from the supervisor. They call the supervisor. He comes and do some his password and all the stuff, and then remove the the entry or whatsoever. All right. Why? Because they have minimizes this opportunity to fraud. For example, somebody just scanned the item and quickly delete from the orders, but receive money, full money. Rest of the difference is in her pocket, and that's it. So it means a weak system. So if you allow your employees to go back to the past and make entries, this creates opportunity, right? For example, a customer comes and deposited his dues on 1st of January, but you didn't record it, or maybe you record it, but the money, because you needed that money, you spent your personal expenses. And then on 3rd of January, you go back to 1st January and delete this entry. And when you receive the salary, and then if you are being caught, then you said, okay, maybe I'm a good man. I don't want to steal the money, but I needed the money, so I deposited again on 3rd of January. Even though your intention was not to harm the business, but this create an opportunity because you are a good man. Others, they are not. Okay? So this is called opportunity. The last one is, which is most dangerous one, is the realization. Which means, okay, this bad system prevails and there is opportunity to fraud, right? But if I don't do it, somebody else will do it. Then why not I? This is called realization. You are on the GM level or on the CEO level, you find out the loophole, and because nobody else can find out, only you can do that. Or maybe on your seat the person can see the the loophole. If new CEO come, so he will find out, okay, there is a motive, or there is some kind of opportunity here. So if I don't do that, then the coming CEO will be doing this kind of stuff. So why not I do that? All right. So this can be done through improving your system. This can be done through smart hiring, good hiring, ethical people hiring. But this, even if you hired a good people, smart people, your system is quite good, but this is very hard to track. Because only that person knows who is on the bigger seat and who knows the system. That's it. And it is hard to find out. Okay, guys, you understand? 10, Priscillo, Marco, PD, Nana, Venetia, Joao Paulo.
Yes, understood.
Okay, good.
Yes.
So our second learning objective is explain the objectives and components of internal control. So now we identified what is fraud, what are different kinds of financial fraud, misappropriation of assets, and fraudulent financial reporting. And then we talk about the triangle of fraud. And now we want to establish a good control in our country, in our company. So that's why we call this internal control. Okay, so what are its objectives? So internal control is a primary way where frauds and errors, remember there is a minor difference, gray area between fraud and error because of humans, right? Both are because of human, but this is unintentional. Unintentional. And this is intentional. Okay, so these are the primary way to prevent, detect, and correct all these three. If somebody is doing or somebody mistakenly did that, it prevents you. There's a pop-up menu, and they are going to tell you that, okay, this is not the figure is like that wrong, or maybe are you okay that this is the final figure, and then you press enter. Detect, if somebody is doing that one, also give you some kind of alarm or some kind of reminder that it is going on like this. If somebody is accessing your account, you get the message, okay, somebody is using your account, you got the email, you got the SMS, all right? Correct. So you can take the corrective action. Management and board of directors implement a plan of organizations and system procedures. Basically, internal control. Okay. Okay, please mute. It's too much noise. Okay. So basically, okay, guys, sorry about that. It was my internet glitch. Okay. So basically, management and board of directors. So when they plan for organization, they also plan for systems of procedures that who is authorized to do what, right? So who is authorized to change the entries, to go to the back date? Not everyone has the access, okay? Who got the access to go to the systems room? It's like that, okay? So you built basically a firewalls and all those stuff for different level of employees. So what are the objective of internal controls? First of all, safeguard of the assets. And then encourage employees to follow policies. And remember, if top management is not committed and is not involved, then internal control cannot be established properly. If CEO is, himself is coming so late, don't bother all those stuff. He has some kind of like a special, way out to go out from the company, come into the company, then employees, they don't follow the procedure as well. If CEOs and managers, they are coming late, then why employees are being, punished for coming late? Okay. Promote operational efficiency, of course, so that business operations go smooth. Ensure accurate, reliable records, comply with legal requirements. Why legal requirements? You have to establish internal control. Why? Because company is owned by shareholders, run by managers. These two are different. So in order to protect the interest of shareholders, the legal requirement is that you must establish adequate internal controls. so that it's not easy for everyone to steal or harm, company assets, steal, money and all those stuff, manipulate the orders. It's like that. So for this one, we have Sarbanes-Oxley Act. So every country has, its own edition of this act. So I'm just gonna go through that. Just pause the video, those who are watching online, and read it by yourself. So I'm not going into detail because every country has its own version of Sarbanes-Oxley Act, or this kind of, act to protect the, to protect the shareholder's right. So here, so the internal control acts as a shield. You see, these are the company assets. If somebody is with this motive or with this intention to make a fraud, it acts as a firewall. If somebody is wasting the resources, also it acts as a firewall. And also operational inefficiencies, it also stops the operational inefficiencies as well. Okay. Now the components of internal control. For the component of internal control, just think about that. This is the company. Okay. The components are risk assessment, which is the outer, outside of the organization. Control environment, which is the roof of the organization. Monitoring, you see, the windows of the organization. Information system and control procedure before entering to organization. So let's see one by one. So we have control environment, risk assessment, information systems, procedures, and monitoring of controls. So let's see one by one. So what is control? Control environment, tone at the top, code of ethics, like I told you. So the managers, even though they are walking silently, they walk like talk. You could, through walking, you can guess their commitment to the organization. So first of all, if you are implementing the internal control, you must see the behavior, the attitude of the top management. If they are serious, okay, they for implementing the policies and following the code of ethics, then you can apply to the lower management. So it's a top-down approach.